Welcome back, guys. Today we're analyzing Adobe. Let's check out the 5-year chart. We're looking at 83% in the past 5 years. That is about the same as the S&P 500, except this does not pay a dividend, so it actually underperformed the S&P 500 in the past 5 years. Maybe it's because it was overvalued back 5 years ago, but now I think it's starting to look pretty decent. Let's take a look and why I think that. $223 billion market cap, absolutely massive company. Their price to earnings ratio is 48, a bit steep, but it's actually not that concerning, and I'll show you why in the numbers. Let's take a look. Financials, the statements. Let's check out their revenue growth. Oh my gosh, absolutely stellar revenue growth, actually. 7 billion all the way up to 19 billion. Insane revenue growth. And even in the past 2 years, even with like the economy and how it's been, they've still been able to grow their revenue by 10 to 12%. And we're looking at their net or their gross margin is insanely high. 16.8 billion gross profit, which is actually insane. And then they're after the operating expenses, which their operating expenses is mostly sales, and then some R&D because you got to pay the developers to make your product and whatnot, maintain it. And then we've got the pre-tax income, and their income is 5.4 billion. It's looking like about a 20% margin. And their last quarter, they actually had a unusual expense here, $1 billion in expense in their last quarter, and so it really hit their margin, hit their net income, and that actually shows up in their net margin. That's why, or their price to earnings ratio. That's why it says 48, rather than a different number. In terms of their balance sheet is looking very good. They have negative 2.7 billion in net debt, so super good there. Cash flow, they actually just buy back stock pretty much. They bought back 4 billion of stock last year. Probably going to expect about the same this year. They might even buy back more stock this year, being that their stock price they might think is undervalued. But we'll get to that later in the video. What I actually think about their stock price right now. Let's take a look at their ROIC right here. Super good. 20 to 27%. Really good on ROIC, and their net margin is super good. Usually at about like 28 to 30%. This 12% was because of that unusual expense. In terms of gross margin, yeah, super high, 85%. Yeah, really good to see margins there. Let's take a look at, I want to show a few of these things. Okay, so by revenue segment, they make most of their revenue from creative products, and then some of their revenue is from document products. They actually had more growth in their document products in the last year. They still had 11% growth in their creative products. And yeah, what products are we talking about here? So this is basically all their revenue, and it's from, or wait, maybe this is in a different currency. Yeah, DME. Or wait, is this in a different currency? Oh, this is quarterly. This is quarterly. Yeah, that's why it's only 3 billion. Yeah, it's quarterly revenue. But yeah, the products here. They have, so this is their creative apps, and this makes up the bulk of their revenue, is all these apps. Most of the time it's a monthly subscription, I can show you that, and their document stuff makes up a smaller amount of their revenue. And is AI going to disrupt this business? It's definitely possible, because AI is going to be able to do a lot of the image generation that currently people use Photoshop for. But also it might be a benefit to this business. They've got some AI stuff, like generative AI, it says here. So maybe AI does something for Adobe. Not quite sure. But these are their products here. You can get their all apps for like $60, and they've got their photography, Photoshop. Yeah, a lot of different products here, and it's all monthly subscriptions. So that's why their gross profit's so high, and these are mostly desktop apps, so you'd run it on your own computer. You just pay for the software. And let's check out the analyst estimates for this company. Average estimate of $18 a share for this year, and the next year at 20. And for this year, 21 billion in revenue, going up to 24 billion by next year, and super tight consensus once again. Probably going to hit pretty much on the dot on that number. Looking at a sales growth of about 12%. Plugging this into a DCF model, let's take a look. Let's zoom this in here. Okay, I put the EPS estimate in, the revenue estimate. Their buybacks of about 5 billion, net debt of negative 2.7 billion, discount rate of 10% because I want a 10% return on all of my stocks, and an exit multiple of 22 because this company has a moat and it's a high quality business. Exit multiple of 22 is completely fair. Could possibly even go higher with that, maybe 25. In terms of earnings growth, I think 12% every single year is completely fair, especially if they have expanding margins. And in that case, they are a buy right now. Their fair share price being $542 a share. And in terms of their revenue growth, I think they'll have 12% revenue growth next year, and then 10% thereafter. I think that is probably going to happen. It's definitely possible that they don't hit this revenue growth because they are such a large company at this point already, but they do have pricing power. They do have a lot of users, and every time they grow to a new user, it just literally just adds straight to their growth. So yeah, the subscription-based model is super good. So I think 10% is completely fair, basically, is what I'm trying to say. In terms of profit margin, they did 28% last year. We could probably expect that moving forward, 28%. And I think their profit margins are going to expand as they could stop spending so much on their advertising. And they could easily get up to 38% margins because it is mostly just they sell the software and that's it. And they don't really have a lot of other expenses other than the sales and the engineers. So yeah, they could definitely make it up to 38% margins. Is that realistic though? I don't know, because in the past they've done between 28 and 35, or wait, yeah, 30, 34, between 28 and 34. So maybe they don't get up to 38. Maybe they just get up to 34. And we'll say maybe they get up to 34% margins. And in that case, they are overpriced by just a little bit. I really don't think that there's much downside in this stock at this point. I think they're going to stay around for a long time. And in the case that this plays out, which I think is super realistic, you're probably looking at a 9% return. Yeah, pretty close to a 9% return, probably an 8% return at least. Yeah, you're probably looking at an 8% return, which honestly I do think this will outpace the S&P 500. So I do think it's a good company. Am I buying it? Maybe, maybe not. I'm not quite sure at this point. There are other stocks that I'm looking at, so yeah. If you have any questions, make sure to leave it in the comments. You can also use this spreadsheet yourself and put in your own growth projections. Maybe you think that Adobe is going to grow much faster than this. And yeah, so just check the link in the description. You can use the spreadsheet. Also, hit that like button, and I'll see you in the next video.